The first half of 2026 was marked by investors chasing the enablers and beneficiaries of disruption, feeding off of short-term price movements. After a resolution to the Iran conflict came into view, investors flocked back into the companies associated with the AI build-out, crowding in select sectors such as semiconductors and industrials that are direct beneficiaries of data center capital expenditures. So this herding behavior in only a few sectors and also the largest companies has masked an otherwise middling market performance in 2026, with sectors such as consumer, communications, and healthcare all actually flat to down on the year. And so this narrow performance has increased concentration risk in the broader market, but also creates opportunity in the parts of the market that are ignored or shunned by investors. We all know AI has been the driving theme of markets for a few years now, but the narrative has actually shifted this year, and one in which AI benefits everything tech related to one that's more discerning between the winners and losers across sectors. So this is inevitable in novel, disruptive technologies like this, as investors generally don't share a consensus outlook and path of adoption for companies that aren't directly benefiting from this new technology. So this is partly why we have seen these dramatic stock price movements in select areas of the market as investors flock to those enablers and avoiding the uncertainty associated with owning the potential disruptees. So what starts as a fundamentally driven run ends up actually turning into one in which price feeds on itself, with investors chasing past performance. This is what creates that concentration risk, which can unwind violently when those same investors seek to reduce exposure to those only handful of companies all at the same time. So to balance this risk in portfolios, we look at the underlying economic fundamentals across these sectors, where valuations are actually in line with historical averages. And so we're adding selectively to those positions where we see long-term value and are proactively taking profits in ones where we see signs that the fundamentals are kind of diverging from prices. And we've recently actually seen some weakness in those crowded names as investors are seeing those same attractive opportunities we've seen in those ignored parts of the market. And so as long as we continue to see a stable and resilient economic environment, we would expect this rotation to persist to the benefit of your portfolios. So we do remain vigilant in our management of risk and keenly aware of pockets where prices and fundamentals may be diverging, as well as on the lookout for any signs of economic deceleration. So if you have any questions or concerns, don't hesitate to reach out to me or Liz. We hope you're enjoying your summer, and we hope you have a great weekend.